If you're a complete beginner looking to invest in the stock market, this is the only video you're going to need to watch on YouTube. So if you guys already know who I am, do me a favor, go down below and skip ahead past this introduction and get right to the video. That way I'm not wasting 1 second of your time. If it's your first time seeing my face, let me quickly introduce myself before we jump right into this video. My name is Ryan Scribner and I've been making financial and investing related videos over here on YouTube since 2016, and I've done multiple videos about investing in the stock market for beginners over the last few years. My last video on this topic was over 3 hours long and has accumulated over 2 million views. So I will put that video up in the corner if you guys want to check that one out at the end. But what we're going to be covering here is a much shorter and more streamlined version of that video for those of you that might not have 3 hours of time to dedicate to that entire video. Now, as far as me, I have been featured in the Wall Street Journal, Business Insider, Market Watch, as well as a number of other financial publications. I also founded the personal finance blog Investing Simple, so I am pretty well known in the overall financial community. Over the last few years, one of the things I have been focusing on more is investing in startups, especially in the fintech space. So I also have a number of angel investments in the neobank and fintech space overall. Now, what I will ask of you here is that you treat this video like a college course or a college lecture. Yes, that means put away your phone unless you're watching this video on it right now. You should also go ahead and grab yourself a drink of some kind, maybe a pencil as well as a piece of paper, or if you want to grab your pen, that works just fine too. But go ahead and get anything that you will need and then get ready to commit for the entire duration of this video. Guys, I promise you, if you watch the entire thing here, you're not going to have to jump around to like 10 different videos on YouTube. I'm going to teach you everything you need to know, basically condensing the last 5 years of my YouTube channel here into this quick, concise video. Without further ado, here's what I've learned about investing in the stock market over the last 7 years. Okay guys, so real quick before we get into the presentation here, I just have to make a quick disclaimer that I am not a financial advisor. This video here is not any sort of financial advice, and you should always do your own research and due diligence above and beyond this video before making any investment decision. That being said, let's dive right into stock market for beginners. So first of all, before you commit to the entire duration of this video, I want to tell you what you should be expecting in this course. Number one, we're going to be covering what is the stock market. After that, we're going to talk about why would somebody make the decision to invest at all. After that, we're going to talk about some of the information about how to trade stocks and some of the ins and outs you might want to know before making your first order in the stock market or buying your first stock. Number four, we're going to touch on some of the basics of how to evaluate stocks. And then number five, we're going to cover some of the best investments out there for complete beginners. Now, on the other hand, I want to tell you what you should not expect from this course. Number one, there are no affiliate links whatsoever. Number two, there's no sponsor for this video. Number three, there's no upsell, there's no pitch, there's no course, ebook, anything like that. Number four, you're not going to get interrupted by ads every 6 minutes like some videos out there. And then number five, there's going to be a minimal amount of fluff. We're going to move very quickly here, guys. So pay attention and make sure you have everything you need. So let's get right into it now. Starting off with, what is the stock market? Well, the stock market is a collection of exchanges through which equity shares of public companies are issued, bought, and sold. So yes, there are both private and public companies out there. Public companies are the ones where you can go out and buy their shares on an exchange. Now, as far as exchanges go, or a place where you buy and sell stocks, the two most common ones here in the United States are the New York Stock Exchange as well as the NASDAQ. But why does the stock market exist in the first place? Well, the stock market exists to allow companies to raise capital. One of the ways that they can raise money to grow the business is by issuing shares. And in addition, it offers individual investors a way to invest their capital or their dollars to grow their money for their future needs. Now, when someone's talking about the stock market, they're often often referring to all of these publicly traded companies, potentially in the entire world. But if you want to break it down into categories, you start talking about sectors. So the stock market is split into 11 different sectors, all of which are outlined here. So we have energy, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, communication services, and real estate. Now, every one of these sectors serves a different part of the economy and is going to have its own unique factors affecting its business. So you then have something called defensive and cyclical industries or sectors. And an industry is simply if you were to take one of these sectors and break it down into something more granular. So for example, in the energy sector, you have the oil and gas industry. So it's just a way of basically breaking things down into a more specific business operation. Now, as far as defensive sectors, these are ones that are going to do best in a bear market or when stocks in general are going down in price. That is when people are fearful. It's often during a recession. You'll hear that word thrown around. So during that time, the sectors of utilities, healthcare, and consumer staples tend to do very well, and so these are often what people call safe haven investments, where they're putting their money there during times of uncertainty to try to have less downside than may be happening with the overall market. So we now understand the stock market and the purpose that it serves, but what exactly is a stock? Well, a stock represents fractional ownership of a particular company, and that's not to be confused with fractional shares. Before fractional shares existed, people purchased whole shares of stocks, and that whole share of a stock is a fraction of a publicly traded company. So when you purchase a stock, you're actually going out and purchasing a share or a number of shares. And the company itself decides how many shares it is issuing to the public. So if they run out of money, they can simply issue new shares. However, that usually makes the share price go down if the company's not doing well, because it's diluting the other investors or making it so you own less and less of that company on a percentage basis. So let's go through an example of this right now, looking at the numbers using Apple. Also, guys, this data here is as of April 4th, 2022. Apple currently has roughly 16.4 billion shares outstanding. That is the total number of shares in the world in entirety. Now, the current price as of this data here was $178 per share. So in other words, you're going to spend $178 to own one single share of Apple stock. Now, if you want to figure out the total value of a company, you simply take the number of outstanding shares and multiply it by the share price. And at this point in time, that would have given you a market valuation or market capitalization of $2.9 trillion. That is the total value of Apple at that point in time, according to the market. So that's market cap in general, but why is that important in the first place? Well, market cap indicates the value of a company compared to other ones out there, and it highlights the market's perception of a particular company's value. So it's always going to be what many refer to as this perceived value of a company. And why I'm calling it that is because if every Apple investor tomorrow decided to redeem their shares, that market cap or market value would collapse very quickly, and there would be very few people cashing out at the top. So the only reason it has that value is based on all of the investors out there that are holding on to Apple stock as a long-term investment. And then the future demand of new people looking to buy Apple makes people come up to the plate, and then they're going to offer a higher and higher price to try to get somebody who already has those shares to sell it to them. And overall, this is what we call supply and demand. So overall, what you're looking at with market cap is that it shows you what investors are willing to pay for fractional ownership of the company. So as the share price itself is changing, it's because the perceived value of this company by the market is changing every time that share price moves up or down, even if it's a single penny. Now, it's important to be familiar with the market capitalization or market cap market value of a company before investing, because this is going to help you to determine the overall risk associated with that investment. So what happens here is that smaller companies are higher risk and bigger companies are often more well established, so there's less risk associated with them. So let's go right down the list here. Starting off here with mega cap stocks. These are companies with a market value or perceived market value of greater than $200 billion, putting them into the lower risk category of stocks. Examples would be Apple, Amazon, and Google. Next up, we have large cap stocks, which have a value ranging from $10 billion to $200 billion. Slightly more risk than the mega caps, but not nearly as much as the smaller companies below it. Examples would be Starbucks, General Electric, and Discover. After that, we have the category of mid-cap stocks valued between $2 billion to $10 billion, and this is putting you into that medium risk category. So these are not well-established companies. They may not even be profitable. They're still chugging along and trying to grow market share, but they're potentially reinvesting most of their money into growth and not so much focused on profitability. Examples of this, and I don't know if these companies are profitable, I'm just saying as far as mid-cap stocks, would be Stitch Fix and United Therapeutics. And then we get into the small cap category here, and these are companies with a market value of typically $300 million up to $2 billion. This is a much higher risk category. Any stock below a $1 billion market cap is high risk category, and it doesn't mean you can't lose money on a mid-cap stock. It just means that the smaller a company is, the more risk there is often associated with it. So in this category, you have companies like Genius Brands, which might actually be micro-cap now because they've had a recent sell-off even further. And then another example here would be Dillard's. So then we get into micro-cap category. That's sub 300 million market valuation stocks. This is going to be the highest risk. It's often penny stock territory. So two companies here, I've never heard of these myself. We have FAT Brands or FAT Brands, and then Astronova are examples of that. Now, despite all of the new fancy investments out there like NFTs and all of these different things, altcoins, if you go out there and talk to someone like Warren Buffett, he's going to tell you that there's 4 main investment options out there. So let's go ahead and cover those now. First of all, individual stocks is a singular company investment where you yourself are going to become the stock picker, and it's essentially like betting on a horse at the races. You're picking which horse you want to put your money on, and you're going to have a general idea of how long you want to hold on to that bet or investment. After that, you have ETFs or exchange traded funds. This is a basket of securities or stocks or companies that track an underlying index. We're going to cover more about this later on, but just think of it as a basket of different stocks. Back to the horse racing analogy, individual stock investing is picking one horse in that race, and then ETF investing, where you own the whole market, is like you're profiting if the entire race goes well and all of the horses do well. After that, we have mutual funds. This is where you have a group of stocks that are actively managed by a team, and this is going to typically be more expensive than other options because those people aren't going to work for free. So you pay a management fee to these advisors who are going to make changes to your portfolio on your behalf. And then this happens in this overall mutual fund where investors are simply buying shares of that actively managed fund. Over the last few years, this category has really fallen out of favor based on one below it here, which is index funds. This is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. So if you talk to Warren Buffett out there and say, hey man, what can I do to invest? How do I become a stock picker? He's going to tell you to invest in a low fee S&P 500 index fund, which is where you're simply investing in the overall performance of the 500 largest publicly traded companies here in the United States. So Warren Buffett knows that the data suggests that you're your average stock picker isn't going to beat the market, so you're going to have your best overall odds of success simply holding on to the broad market as a whole, or back to that horse racing analogy, betting on the outcome of the entire race. Now, of course, guys, many people will say there are other investments out there. That is the point of the asterisk at the bottom. Yes, you have things like bonds, annuities, savings accounts, some might call that an investment, cryptocurrency, options trading, forex futures, NFT, blah, blah, blah. I'm talking about the main categories according to, the old school money out there. So a common buzzword you're going to hear in the investing community is diversification. And this is where you are spreading your money out in different places rather than putting it all into one. And the common saying to explain this is, don't put all of your eggs in one basket. If that basket breaks, all of your eggs are going to break. So you want to spread your eggs out across multiple baskets. So portfolio diversification is something that comes into play if you want to manage your money yourself. If you want to have built-in diversification, all you have to do is go out and buy a low-fee index fund, and you're diversified across hundreds, if not thousands, of companies. But if you want to be a self-managed investor and build your own portfolio, these are the basic steps you would follow. Number one, you're going to want to have multiple market sectors or exposure to different parts of the economy. And again, what we have here are an example of these defensive sectors. Some of them here, consumer staples, energy seems to be right now defensive with this inflationary environment, but that's not always the case. So beyond having your money in different areas of the economy, different businesses of the economy, number two, you want to have various market cap groups. So you want to spread your money out between very big companies, medium-sized, and if you are a younger investor, some smaller companies as well. Because what happens is that those smaller companies, some of them are going to become the bigger companies 10 or 20 years down the road, and that could supply investors with a lot of growth if they're able to hang on for the long run. However, in the short term, those smaller companies are susceptible to those boom and bust cycles of the stock market, where you're going to have more up and down movement, referred to as volatility. And then third and finally, you're going to want to have different investment options in your portfolio. So that could mean individual stocks as well as ETFs. And then you're going to want to also have diversification across numerous asset classes. That's why someone like me invests in real estate as well as, startup private equity investments, publicly traded stock investments, and all sorts of different things. Again, cryptocurrency, I hold some of that as well. I hold some gold. You sort of put your money all over the place. That way you're not too reliant on one singular thing. So how do you make money in the stock market? Well, there's two primary ways this is accomplished, and it's called asset appreciation or dividends. The one most people are familiar with is asset appreciation, where the value of the underlying asset increases. So for example, you buy one share of XYZ company for 20 bucks. 3 months later, you sell that for 30 bucks and you made a profit there of 10. The second method here is through dividends, and this is from larger, well-established, profitable companies that may not be growing as much, but they still want to reward their shareholders, so they give them some of their earnings. So let's say company XYZ hasn't really experienced much growth. They're done investing the money back into the business, so they want to pass it out to shareholders in the form of these quarterly dividends. So this company decides to pay a dividend here of, let's say, 3% yield based on the dollar value of their dividend payout and then the current market value of the share. That's essentially what determines that dividend yield. But the company doesn't really go out there and say, hey, I want to set a yield of 3%. They determine a cash value of that dividend, and then based on the current market value of that company, perceived market value, that determines the current dividend yield. You're typically going to see somewhere between 1 to 3% for stocks that still have some growth potential, 3 to 5 on more of the income side, where there's not nearly as much growth, but they still make money. They're just not really growing the business. And then on the higher side, 8, 9, 10% yield, sometimes that can be a red flag, and other times you'll see that in certain sectors like energy, where you have lower overall market valuations. So that's just a little tangent there on dividend yield. So to cover an example of it here, let's say you owned one share of XYZ, company worth 30 bucks. You would receive $1 annually per share that you owned in this specific example. Now, in all reality, it wouldn't normally be like that because companies usually pay dividends on a quarterly basis, every single quarter, which is going to be the 3-month categories broken out of January, February, March, and then so on and so on. It's important to be aware of this because a public company is going to report quarterly earnings. We're going to talk about that later, but I just want to cue you in on some of this terminology early. That way we can build upon it. And if this is stuff that's repetitive, guys, or you already know it, I do apologize. I just want to make sure we're helping everybody out here. And if you're a complete beginner, you've never heard these words, I want to make sure I'm helping you out as much as possible. So of course, most people invest to make money. It's not usually a hobby, but there's other reasons why you should and often need to invest your money in the first place. And here's the most common reasons. Number one, increasing your wealth. Well, we've had a 10% historical annual return from the stock market over the last 100 plus years. Now, no, it did not go up in a straight line. There's been boom and bust cycles where it goes up and then comes down, but that's the overall return in the long run. Second of all, it's a hedge against inflation, and it was as high as 7% in 2021. It's been even higher in early 2022, and inflation is literally just the deterioration of your buying power because everything else around you is getting more expensive and your dollar value of your bank account is flat. That's because you're trying to beat a savings account when you're investing. If you're getting just 0.06% APY, which is the current average savings rate, that's no way to build your wealth. You're going to end up losing money every single year as you save it. So that's why people invest their money. Now, that being said, when you do invest your money, you're essentially taking on risk. You're saying, I am willing to have this investment potentially go down in value because I also want to have the chance of it going up in value. And that risk is going to be different based on many factors, but a lot of it has to do with that market cap or market value of these companies. But beyond that, instead of just like the risk that an individual company has, there's multiple different types of risks that you should be aware of. First of all, you have market risk. This is events that impact the entire market. So think like the pandemic or the 2008 housing crisis. It doesn't matter what asset you owned. It doesn't even matter if it wasn't a stock. There was nothing unaffected by those events. Then you have concentration risk, which is where you have a decline in value due to a lack of diversity. So if you put all your money into one particular stock and that company doesn't do well, the rest of the market is doing well, you're getting left behind because you haven't made money because you made a bad investment, you picked a bad horse. And then of course you have inflation risk, which is the loss in purchasing power due to inflation. So we all know about that buzzword now. We've explained it already, and here's an example. $100 in 1950 is the equivalent value of $1,105 in 2022. So what you could have bought back then for $100 would now cost you a little over $1,100. Now, you may want to shy away from risk, but you can't look away from all risk entirely because that's the equivalent of your savings account where you're literally guaranteed to lose money based on inflation. So you need some amount of risk to have some type of reward, and it looks just like this chart right here. At the very bottom, you have low risk, low return investments, maybe something like bonds or a certificate of deposit, and these things are not outpacing inflation. You're just losing a little bit less money every single year versus the savings account or cash. And then all the way on the other end, you have high risk, high potential return investments, unprofitable companies, growth stocks, small caps, high risk. Yeah, there's a high potential return, but you also might lose 90% of what you put in if you make the wrong decision. So that's the main reason. You invest to grow your wealth. You accept some risk to earn more than a savings account, but the key here is every person out there is going to have a different risk tolerance. So what often happens is people don't take enough risk and then they get outpaced by inflation and they just never really accumulate any wealth. Or in the other category, they basically take on way too much risk and then they have a massive loss. It turns them away from the stock market or something, or they're underwater in an investment for many, many years or decades in some cases. So you just want to make sure that you're not taking on too much risk Everybody has to find the correct amount of risk that allows them to stay in the market for the long run versus going in and out of it. So now let's talk about the basics of how to trade stocks. Let's start off by talking about order types, and we're going to focus on the market order and the limit order, the two most common ones out there. So a market order is simply an order at the best available price at that instantaneous point in time, and this has to be filled when the market is actually open. And those market hours are 9:30 a.m. Eastern Standard Time to 4 p.m. Eastern Standard Time, and the stock market is closed on weekends and holidays. A market order in shares buys or sells a specified number of shares, but more commonly with fractional shares. We now see more people doing market orders in dollars to buy a specified dollar amount of a stock. In the past, guys, it was kind of a pain to buy companies with a high share price, like Tesla, for example, because if you didn't have $800 or $900, you couldn't buy a whole share. Now, pretty much all brokerage platforms which you use to trade stocks are going to let you buy fractional shares. So I could put $100 in Tesla and have a fraction of a singular share of that stock. So that's how a market order works. Next, the limit order. This is where you have an actual price target in mind where you're setting that order to trigger. So for example, here, if you look at the chart, that shows where the buy order is triggered at that dashed line there, the limit price. So how that would work, let's say Apple's $175 per share, and I say, in my opinion, it's worth $160. That's the price I would personally pay for it. I could put a limit order out there to buy 10 shares of Apple at $160, and it could sit out there open for, I think you can leave an order for like 45 days if you want. But if it ever hits that line, that order triggers, and I buy my 10 shares at $160. If it's $160 and 10 cents, that doesn't matter. The order is not going to fill. You're specifying the exact price that you want to either buy or that you want to sell. With a market order, you're basically just getting the best price right now when buying or selling, but you have the guarantee of your order being filled as long as it is a company that has people trading it. This is called liquidity. That's why you want to stick to the major exchanges, the New York Stock Exchange and the NASDAQ, because if you're trading a penny stock, there's not necessarily a guarantee that there's a buyer on the other side looking to purchase your shares. That gets a little bit confusing here, guys, but that's just, again, another tangent there and something for further research on your own. So now let's talk about one of people's least favorite investment topics, and that is taxes. However, this is my philosophy when it comes to investment taxes. Be aware, not beware of taxes. So what do I mean by that? I mean, educate yourself and understand the tax advantages of, for example, going long versus short-term capital gains. Yes, long-term investors pay less in taxes on their gains from the stock market and oftentimes on the dividends too. So there's financial incentives to keep your money in stocks or in the market for the long run versus short-term trading. Now, when it comes to investment taxes, you're going to have two things at the end of the year. You're going to have your capital gains. You're also going to have your capital losses. Now, you may or may not have dividends. It depends whether or not you invested in dividend stocks. But let's start by covering capital gains. This is a profit from the sale of an investment. For example, you buy XYZ stock at 100, sell it for 110. The capital gains there are $10. Then let's talk about capital losses. This is when you actually sell an investment for a loss or less than you paid for it initially. So if you bought XYZ stock at 100 and you sold it for 90, you now have a capital loss of $10. Now, this is going to be important for a number of different reasons, but one of the main ones is that your capital losses do offset your capital gains. So if you made 10 grand but lost $3,000 on other stocks where you sold for a loss, your true capital gain is now only going to be $7,000, which is the amount you're taxed on. And again, going long in the stock market and holding on to stocks for longer than 1 year is going to give you favorable tax treatment. That's all we're covering on taxes, guys. I have a full video on investment taxes I will put in the corner. Check it out at the end of this video, guys. Don't click on it right now, but at the very end, that'll give you everything you need to know about investment taxes. Also, if you have found this video to be valuable, please drop a like for that almighty YouTube algorithm. That really does help a lot and allows this video to be shared with other people. So how do you actually evaluate a stock or determine the fair value of a stock? Well, there's plenty of different ways to do it, and there's no one set method that is right or wrong. But doing any type of research into valuation can help you avoid some of the biggest pitfalls and losses in the stock market. There's about 6,000 stocks. If you look at the New York Stock Exchange and NASDAQ, it will be impossible to be familiar with even 5%, 10% of these, maybe 5, but not 10% of these companies. So with so many options, how can you know which stocks are the best? That is where company valuation comes into play. So when evaluating stocks, there's three main principles that people look at. Number one is the fundamental analysis, looking at the financials of the company, trying to determine what that person deems as the fair market value for that company. Or if you're looking at a potential investment, you're trying to figure out, okay, the market as a whole, what are they valuing this company at in terms of a multiple of their revenue or sales or some financial factor like that. The other thing is technical analysis. That's the chart, or what people often refer to as the personality of a stock. That's going to show you the up and down price movements, and that's what traders care about. No, not a trader like someone who betrays you, like a trader, somebody who trades in and out of stocks for short-term gains. They're just looking at the charts and they're trying to trade based on momentum and different factors. Then you have qualitative research, and these are the intangibles, the things you can't put a number on, but they're still important to the overall value of a company. One of those is, for example, how the public perceives that company. Public perception, you can't put a specific number on it, but it can be very important when the public is essentially the ones buying or selling a stock, which sets that market perceived value. So these are the three main things people are looking at when evaluating stocks before potential investment. So let's start off here with company financials. So basically, a publicly traded company is updating investors on three main financial statements on a quarterly basis. That is the income statement, the balance sheet, and then the cash flow statement. Collectively, this makes up the quarterly earnings report, in addition to any commentary that the executives within the company want to share. And then, of course, you have guidance, which is what they expect to happen in the future, but not every company out there is going to offer that forward-looking assumption to their investors. So starting off here, what is the income statement? So this is going to highlight a company's financial performance over a period of time. This shows you revenues, how much total money is coming in, expenses, how much money went out chasing that money coming in, and then net income, how much is left over after we paid the bills. Did we make money? Did we lose money? That's what the income statement shows you. After that, you have the balance sheet. This is going to show the company's assets. This is like your net worth, your personal net worth. Add up all of your debts and all of your assets, your investments, the value in your house, the value in your car, subtract your car payment, your mortgage, your credit card debt. That dollar value, that is something you would find out on the balance sheet of a company. It gives you basically a bird's eye view into the assets versus liabilities of a public company in a snapshot of time. And then third and finally, the cash flow statement. In my opinion, is the least important. This reports a company's movement of cash flowing in and out. It shows you how the company is financed. Again, I find that to be the least important for me. The balance sheet is usually my number one, because that's what's going to show you if a company can survive, a bear market. It's basically like if you were a person with a lot of debt and then you're going to lose your job or your income goes down, are you going to be able to make it or are you going to flounder? The same thing happens with a company. Some of them take on too much debt and then they think things are going to be great in the future and then they're not. And then they run out of money and then they're in trouble. And that's when the share price goes down. The balance sheet cues you into if a company has good assets, if they have a good net worth, if you were looking at, a human being. So those are company financials. So let's dive deeper into the income statement now and take a look at one here. So here we have an income statement from Apple, and the source here is from Yahoo Finance. It's a great resource for finding this information for free. pretty much any publicly traded company out there. You can find those 3 financial documents for free with no account on Yahoo Finance. So this is what one of these documents looks like, and you can see the vertical columns there show you that period of time. Keep in mind, these are always going to be an instantaneous snapshot in time. So here are potential questions that you would ask yourself that you would then be able to answer when you fully understand an income statement. You're not going to understand one right now. I just want you to know what this document is. So this is going to show you, are the company's revenues growing? Are they bringing in more money each quarter and each year? If it's a growth stock, they should be. After that, are expenses growing or declining proportionally? Because if they're bringing in a ton more money, but their cost of revenue, the cost of going out and getting that money is growing even faster, the net or the difference is shrinking. So that's something that's very important to watch out for. Sometimes you'll see 20% revenue growth, but cost of revenue could be growing at 25, minimizing the difference or the net, which is going to show you the net income. And then that's why you want to be sure to look out as well, is the company's net income growing? If the company's net income is not growing and it's shrinking on growing revenue, that's just not a positive. Ideally, you want to be seeing revenue growing and then cost of revenue keeping pace or growing proportionally, and then net income growing as a result if we're talking about a growth stock. Next up, we have the balance sheet. Here we have a balance sheet, again for Apple from Yahoo Finance. Apple has one of the best balance sheets out there. They have a really solid portfolio of assets and liabilities where there's really nobody out there that's concerned about Apple meeting their future obligations or expenses. So using a balance sheet, you're able to answer these questions. How is the company managing its debt, both short-term and long-term debt, and how much debt do they have? Next, you're able to answer, how is the company financed? Are they self-financed by sitting on a pile of cash or cash and equivalents, marketable securities, all equivalent? Basically, what happens there is, a company is going to do what we do and put their money in low-risk investments, treasuries, not the stocks, but guaranteed things that aren't going to lose value. They're going to put their cash in treasuries to try to earn some rate of interest because they're also worried about inflation instead of just leaving it sitting there in the bank. So that's just another tangent there for you guys. So it shows you how the company's financed and what is the company's cash position, and that is why a lot of people invest in what's called a cash cow, which is a company that's sitting on a big old pile of cash. An example of that would be Google, and then looking here at Apple, if we look at their cash and cash equivalents, we would have to open up total assets to be able to see that, but I'm sure their cash positioning is great. But even just right off the rip here, looking at that most recent quarter, which was 9/30/2021, this company's got $351 billion in assets on $124 billion of total debts. So that would be like if I had $351,000 of assets and my total debt on my mortgage, my car payment, my everything was $124,000. I could basically sell a bunch of stuff and then pay off all of my debts and still have, like, in this case, something like $230,000 left over. So most would argue that's a pretty good financial position to be in. That's the equivalent here of Apple, and that's what the balance sheet shows you. And then finally, the cash flow statement. So again, like I said, I don't really spend too much time here, but this is going to be able to let you answer these questions. Does the company have a healthy cash reserve? That also you can see from the balance sheet. And then what are the company's sources of cash? This, again, just shows you how a company is financed, the inflows and the outflows of cash. So moving on from the core financial documents, let's now talk about financial ratios. Well, financial ratios are taken from the 3 financial statements that we just talked about, and they serve as a score to a company. So it's kind of a pain to go look through all of those documents, and since there's over 6,000 different stocks out there, if you're looking at many different ones, people don't really want to spend the time combing through all of those documents. So these scores exist out there, similar to like statistics out there on a given racehorse basketball player, whatever it may be. So hundreds of ratios exist. There's no one that's right or wrong, but people find ones that they like for them to build their overall strategy. Ratios are best used as a benchmark versus other companies in the same sector or same area of the economy. So you would compare a healthcare company to another healthcare company. It would not be useful to compare the valuation of Tesla to United Healthcare. They're in completely different sectors that have their own risk and reward profile and all of these different things. So you cannot compare. It's not an apples to apples comparison. That's apples to oranges. So that is the use cases here for these financial ratios. There's a few hundred out there. Like I said, we're going to focus on 3. Number 1, the current ratio. This is where you take current assets, which is assets that are in cash or readily convertible to cash, versus their current liabilities, which is their debts that are due in the next 12 months. This is going to show a company's ability to cover its short-term debts. So you want to look for a score greater than 1. So if you want to do just the most basic level of research on a company, just Google the company name followed by current ratio. If it's greater than 1, they're going to be able to most likely pay all of their debts due in the next 12 months. If it's below a 1, they're not going to be able to. They're going to have to get more cash. And the most common way they're going to do that is issuing shares, diluting. You're going to own a smaller percentage of that company, and the share price is most likely going to go down to adjust and account for this. So current ratio, super helpful. Next up, price to earnings ratio. This only applies to profitable companies, but it also gives you an easy way to determine if a company is or is not profitable, which is where their revenue coming in exceeds the cost of revenue and all of these other factors, and they actually have earnings at the end of the day. Now, the way this is calculated is you take the current share price of a given stock and divide it by the earnings per share over the last 12 months, and that's going to show you what an investor is willing to pay per earnings. So the best way I've ever heard it described is that the PE ratio tells you what an investor is willing to pay for exposure of $1 of company earnings per year. So if a company had a PE of 30, it means someone is willing to put up $30 to have exposure of $1 of earnings from that company per year. It doesn't mean it's going to necessarily all go back in their pockets, but it's just the multiple or the valuation above their earnings. That is what valuation comes down to at the end of the day, is the future value of that company's earnings. And then finally, the debt to equity ratio. This is going to show you total liabilities divided by total shareholder equity. This shows how a company is financed. And again, it's a really easy score to just take a look at. A score of greater than 1 indicates a company has more debt than equity, so you would not want to see a higher than 1 debt to equity ratio. And even a score of 1 means they have an equal amount of debt as they do have equity. So that's the basics of company financials, and in my opinion, the 3 most important financial ratios out there. Congratulations, you now know more than 90% of people out there investing in the stock market. I'm not even kidding. Ask your friends, what's your favorite valuation metric when looking at a stock? And they're probably going to look at you like you have 2 heads, because their investment strategy is just FOMOing on Reddit stocks or something like that, most likely. So that's basically how you use them, but where do you find these in the first place? Well, one place I recommend is a company's investor relations page. This is where they're going to provide financial statements and postings of anything that investors should be aware of about that company. And then, of course, you have financial websites out there. Yahoo Finance, they have free access to those income statements and those other financial statements. MarketWatch.com is good for ratios. They're also on Yahoo Finance. And then, of course, the Wall Street Journal is a good publication as well. So that's it for financials. Let's now talk about the technicals, or the price movement, or simply looking at the chart. Technical analysis is research using 2 variables, which is price and volume, to predict future price movements. And that is all that a stock trader is doing, is using the price and volume and then other indicators, that may be based on price and volume to then try to predict future price movements and profit on them. Now guys, I'll tell you this, if technical analysis and day trading was easy, everyone would be doing it. But I'll tell you what, it is not, and most people are unsuccessful with it. However, I still do apply some technical analysis to my overall long-term investing strategy because this can show me optimal entry and exit points for a stock. Now, what you're looking at here is a basic line chart of the price of a stock over time. But when you're actually talking about technical analysis, most people are referring to this stock right here, which is the candlestick chart. Now, you're going to have to look into this further on your own if you want to do a crash course on technical analysis. I am not the person to teach you that. I have done some technical analysis on candlestick charts, and I do utilize these for support and resistance areas, things like that. Like, for example, that red line is called the 200-day simple moving average, and you can see here where Apple stock bounced off of it sometime there in March. And then the blue line up there is actually the 50-day moving average, the average price over the last 50 days versus 200. One served as a support, one served as a resistance, and you can see where we broke out above that and ended April above that 50-day moving average. You also have RSI up top. I'll just give you a quick explanation. When that turns green, it's probably time to sell. When that turns red, you might want to buy. Again, don't follow it verbatim, but it gives you an indication based on momentum if things are getting frothy where, okay, there's probably going to be a sell-off, or has it gotten too sold off and people are going to start buying the dip really quickly and it's going to recover. Last one I'll throw at you is the very bottom, the MACD, moving average convergence divergence. I couldn't tell you again where this comes from, but you just want to watch for that black line to cross over the red line, and that tells you momentum's on your side, and some people literally use that as their indicator of when to buy and when to sell. They buy as soon as the MACD crosses over, the black line crosses over the red, and then they sell when the black line crosses below the red. That's their investment strategy. So that's the basics of technical analysis here, guys. Now let's get into qualitative research, or the things that you can't put your finger on or get an exact number on, but are still really important in terms of how a company is valued. Because keep in mind, although there's a lot of institutional money going into stocks, there's also retail money going into it, and that's us average people investors. If average people investors like a company and they're buying the stock, that means it's going to push that price higher and higher as people are holding on to shares and there's more demand. If a company is making a bunch of money but they piss off somebody and there's a bad PR nightmare and the public doesn't like that company, you better bet that share price is going to take a hit. So you can't just look at the technicals and you can't just look at the fundamentals. You also have to look at these intangibles if you are a long-term investor. If you're a trader, you don't care about financials and you don't care about qualitative research. You strictly care about price and volume, and then different indicators and things based off of price and volume over time. So qualitative research is the most difficult form of research out there on a stock, but I'm going to give you the three main categories that people look into. Number one, company and market news. This is going to show you what is the latest with the company. Are they having new product launches, changes to management, etc., as well as what is happening in the market that may impact the company. So for that, you pretty much just want to type in the name of a company you're investing in and then navigate over to the news tab on Google and look in that over the last maybe 3 months and just see if there's any positive or negative news about your company. After that, we have sustainability and ethics. This is also referred to as the ESG, and this is becoming more and more important to investors. And this is showing you how a company is as a custodian to the environment and socially and different things like that. Are they a good member of society, and are they treating the planet well? So this is going to show you if this company is taking on new initiatives to reduce their carbon footprint. That's becoming increasingly important for investors, and these forward-thinking companies tend to command a higher valuation or a higher PE ratio because they're adopting and innovating for a cleaner tomorrow. In addition, does the company engage in any practices to help give back to the community or give back to others? You know, are they giving back and helping? And how does the company source its products? Are people being treated fairly during the different steps of that supply chain? All of that is looked at in the category of sustainability, ethics, or in general, just the category of ESG. Finally, competitive advantages, or what some would refer to as the moat. A moat is that water around a castle that stops people from invading. It makes it difficult. You've got a bridge and you can lift it up, and unless someone's going through that water, even if they did, you've got the advantage. They're in the water and you're up top in your castle. That's the competitive advantages that a company has. Looking at this is going to show you what sets a particular company apart from the competition. So examples of this could be their core competencies or what the company is good at, brand strength, unique product offerings, patents, intellectual property, etc. So studying a company's moat is basically allowing you to answer the question, how difficult would it be for me to go out there and do the exact same thing and compete with them? So a famous quote from Warren Buffett about moat is that he has pretty much said that somebody could give him theoretically any amount of money in the world. And if they told him he had to create a beverage company to compete with Coca-Cola, he would hand that money back and say it simply cannot be done. So Coke has a massive moat with their portfolio of beverages, brand strength, and so many different reasons. On the other hand, a company like Uber doesn't have much of a moat, and that's why, Lyft has been able to essentially do the same thing, and they've been pretty competitive with each other. Another example is brokerage platforms. A lot of people jump from one to the other because there's not much of a moat or competitive advantage or anything really separating one apart from the other. Now, as far as finding this information about the qualitative research or the intangibles, it is difficult, and it's often going to, like I said, take the most time. If you are looking to do it simply, this is the only thing I'm going to be pointing you guys towards here, and it's one of my startup investments in the fintech space. It's an app that I really believe in myself, and I find it to be a very helpful tool for investors. It's called Front, and it's a free stock research app. This is a free app that analyzes your portfolio as well as a stock that you might potentially be out there looking to buy. And then it's also going to be making recommendations to you of stocks you might want to put on your watch list based on your portfolio. It's going to give you tailored recommendations. You're also able to connect not only brokerage accounts, but also cryptocurrency accounts and track all sorts of investments in one place. So rather than opening up like all of these different apps, you can get a snapshot of the performance of your whole portfolio with whatever you have connected over on Front. Now, the main reason why I'm talking about Front is because they offer a proprietary scoring system called the Front Score. And you might as well just call that the credit score as if it was your own credit score. This looks at all of these different categories and gives you a score based on all of them. It looks at diversification. So if you connect your brokerage accounts, it's going to show you if it's a good diversification move or are you potentially putting too many eggs in one basket. It looks at the financials and is going to give you a score based on all of those financial statements. It looks at historical performance, which is basically your technical analysis, and tells you whether or not momentum is or is not on your side. There's a saying in investing, the trend is your friend, so typically you want to follow the prevailing trend. In addition, the intangibles, the ESG, as well as the news and updates, it gives you a score based on those. It has a proprietary algorithm that can determine if news is positive or negative and give you a score surrounding that. So it's a really simple score. It's completely free. You can put any stock in there and get a score. For example, AAPL is Apple, and they had a score here of 733, putting them in the good category. So if you guys want to check that out, it's going to be getfront.com/Ryan, completely free download in the App Store, or you can click the link down in the description below at the end of this video. Once again, I am an angel investor in this company, so this would be giving back to me for putting this video together if you guys want to. However, it's only if you think it's a useful tool, and at the end of the day, I put my money into this company because I believe in it myself, and I use this app as part of my ongoing research and portfolio tracking. You can also follow me on Front at Scrib, S-C-R-I-B, and if you comment on any of my posts, I will 100% respond to you over on Front. So it is also an easy way to get direct communication with myself. That's it for the pitch here, guys. That's the only thing in this entire video that's not straight value, and it really is value. This app is incredibly valuable, but I wanted this video to be as non-promotional as possible. So moving on, let's now get into the best investments for beginners. Again, make sure you do your own research above and beyond this video. This is just a guideline based on the historical performance of these investments over time. So if you're a complete beginner and you want to go out there and bet on a horse, pick a horse in that race, or buy an individual stock, let's talk about 3 stocks that are good for beginners. Number 1, the Warren Buffett favorite, Coca-Cola Company. Now, again, this price data here is as of April 4th, 2022, and prices have actually gone down, so we're not going to actually look at that data there, but we're just going to basically talk broadly about these companies. So we already talked about the moat that Coca-Cola has and how it's difficult to compete with them. Very well-known brand. It makes this a good investment. They also pay a dividend. Actually, all of these pay a dividend, but Apple is still more of a growth company, so they don't pay really nearly as much on that yield basis. So yeah, number 1, Coca-Cola. Number 2, Apple. You know, I believe it's the most valuable company in the world. If not, it's Microsoft, and they sort of are interchangeable there, but a company I've owned in the past, I've owned actually all 3 of these companies in the past. I don't own them currently, but they're all really solid picks for beginners. And then third and finally, Johnson & Johnson. They have all sorts of medical patents and intellectual property. They're also, I believe, one of the only companies to have a perfect credit score rating by Moody's and Standard & Poor's as far as their credit worthiness. I think it was just Microsoft and Johnson & Johnson. And if I'm not mistaken, it might just be Johnson & Johnson is the only one left on that list. So really, really solid pick there, guys. Excellent long-term investments across all 3 of these. But again, do your own research and be familiar with these companies yourself before investing in them. And then let's cover 3 ETFs, or index funds for beginners. An ETF is simply an exchange-traded fund. So you take an index fund, you break it up into shares, and you allow investors to purchase individual shares of that company. All of these are going to pay a dividend, and that is something paid out on a quarterly basis. All of the dividends earned by those companies are collected together, and then it is paid out once per quarter to investors. So first of all, we have VTI, which is the Vanguard Total Stock Market ETF, which has over 4,000 individual holdings. It gives you exposure to the entire stock market. So that is one that you may want to consider for the largest amount of diversification. However, you are also having a decent amount of money in small caps and mid caps, which might be more risk than you are looking for. So that's why the next option is popular for many, and that is a S&P 500 ETF. We're using SPY here, and this has 507 holdings here. It's basically, I don't know what the other 7 are there, but you know, for the most part, it should be the 500 largest publicly traded companies in the US. So now you're focused on large and mid cap, and you don't really have any small cap in that mix. So this is the most popular option for ETFs by far, is an S&P 500 one. And if you're a Vanguard fan, then there's also VOO. And honestly, guys, these things are pretty similar. There's not much of a difference between VOO, SPY, and the different S&P 500 ETFs out there. So third and finally, if you want to be a bit more aggressive and take on a little bit more risk, we have IJH. This is a product here from iShares. This is the core S&P mid-cap ETF made up of 407 mid-cap or mid-sized market cap companies. So you're looking at a little bit more risk and reward there, but also a little bit more downside proportionally. So somebody who is younger, who's trying to focus more so on growth of their money, might be looking to put more of their money over into, you know, this mid-cap fund. Now, each person out there, if you were to have a well-diversified portfolio, would have a mix of different ETFs. But again, some people just follow that simple strategy of, you know, putting money into a low-fee S&P 500 index fund and basically setting it and forgetting it. Real quick, guys, I want to teach you my favorite strategy when it comes to investing, and it's one that can keep you out of trouble as long as you do your research on the onset. So if you're looking at, you know, doing some evaluation of a stock and making sure you know if they're profitable or a general idea on the market valuation. At that point, if you're beginning to say you want to buy shares of that company, a great strategy to follow is dollar cost averaging. And here we have a quote from Benjamin Graham, who wrote a book called The Intelligent Investor. It's basically like the Bible for investing. Warren Buffett was somebody who learned directly under Benjamin Graham, so very well known in the investment community. When referring to dollar cost averaging, he said such a policy will pay off ultimately, regardless of when it is begun, provided that it is adhered to conscientiously and courageously under all intervening conditions. So what he was saying there is, as long as you start and never stop, no matter what's going on in the market, as long as you're putting your money into the right things, you really can't go wrong based on over 100 years of history. Now, in layman's terms, what this would look like is this right here. Let's say you had $50 a month that you were looking to invest every single month. If you made a recurring $50 contribution into a stock or fund, you would be following dollar cost averaging. Believe it or not, guys, we've come to the end. We're at the last slide. I really appreciate those of you who stuck around to the very end. I want to cover my 5 pointers here if I had to give you guys 5 pieces of advice before you buy your first stock, or even if you already bought one and maybe you lost some money. Let me just give you my top 5 pointers. Number 1, 10% is 10%, whether it's $1 or $1 million. A lot of people will compare the dollar gains of someone else's portfolio to the dollar gains of their portfolio, and that is nonsense. It's not an apples to apples comparison. The only fair comparison is on a percentage basis. 10% gain on 1,000 is equivalent, as far as the percentage gain on $1 million. Some people just have $1 million versus 10,000. You don't have control of that, but you can control the factors that affect your return. So do not focus on dollar value of gains. Focus only on percentage value of gains. Number 2, if you can ignore the hype, or maybe not ignore it, but do some analysis and evaluation of the hyped stocks. If you're able to find something that is maybe hyped, but understand the valuation and say, I still feel like I want to own it, at least you know that it's overvalued, and you're not going to get rug pulled when everybody else who didn't do their research doesn't even know what's going on. So that's something where I could go either way on that one, but as a beginner, you probably want to just ignore it and stay out of the hype. Number 3, keep the long term in mind. Not only are there tax benefits to this, but that's how most people have been successful in the market, is in the long run, not in the short term. Number 4, emotions don't mix well with investing. So if you find yourself making a quick emotional decision where you're like, oh, my heart is racing, I'm gonna place this trade, take a breather and make sure you're making the right decision on either the buy side or the sell side. Emotional decisions are just not good. And then 5th and finally, I like to treat investing like a solo activity, like golf. It's not a competition, and you just shouldn't compare yourself to other people out there. It's like comparing salaries or how much money you make. It really doesn't matter. It's all about you yourself, building your wealth and protecting yourself from inflation. Guys, thank you so much for watching. I really am thankful for those of you who stuck around to the end. If you made it to the very end, make sure you drop a like if you haven't already, subscribe, and hit that bell for future notifications. Leave me a comment down below if you have any thoughts or feedback. And then, like I said, if you want to chat with me, make sure you follow me at Scrib over on Front and connect your different financial accounts to take advantage of all of those great features over on Front. One more time, that is getfront.com/Ryan. Thanks so much, guys, and as always, I hope to see you in the next video.